right now, at this exact moment, millions of everyday people have their financial safety nets set perfectly in place. You know, they're looking at their trading screens, they're plotting out yesterday's lowest prices and, well, placing automated orders just below those lines to protect their money.
Right.
They think they are practicing safe, responsible risk management. But to the massive institutional algorithms that are running the global markets, those safety nets aren't protection. They are bait.
Yeah, it is a really harsh reality to wake up to, honestly, because what feels like playing it safe to the average person is actually the exact fuel required for the biggest players in the world to execute their strategies.
And that is exactly the mission of our deep dive today. We are looking at a highly detailed blueprint of market behavior. Specifically, we're focusing on a setup that happens on the euro to US dollar currency pair, though I mean, the asset itself it doesn't even matter.
No, not at all. It applied almost everywhere.
Right. So this concept is called the previous day high-low liquidity sweep. And look, I promise you do not need an economics degree to grasp this.
Definitely not.
We are going to decode what looks like a really intimidating wall of financial jargon into a simple, fascinating psychological game of cat and mouse. We're going to uncover how smart money like the massive hedge funds and huge banks, how they operate, how they manipulate the market, and why everyday people just fall right into their traps.
Because at its core, you know, this isn't a conversation about complicated math or anything. It's really a masterclass in human psychology. It's about how big systems operate.
Exactly. Even if you never trade a single currency in your life, understanding this blueprint reveals a ton about just human predictability. Okay, let's unpack this, because before we can understand the trap, we have to understand the battlefield where the trap is actually set, right?
Yeah, that's the perfect place to start. You have to draw the lines in the sand first.
Yeah.
So on this chart, we have these concepts called the previous day high, or PDH, and the previous day low, the PDL. And to a completely rational computer, the highest and lowest prices a market reached yesterday are just trivia, just random numbers. But to human beings, they aren't random at all. They become massive psychological boundaries.
It's kind of like, the high water and low water marks left on a beach after a big storm. You walk out there the next day, you see that line of seaweed on the sand, and everyone just logically assumes, well, that's where the water is going to stop today.
That is a great analogy, yes. Yeah. And that logical assumption completely dictates where people put their money. So regular, everyday traders, retail traders as they're called, they look at those high and low marks and they set their safety nets right outside of them.
Which is what they call a stop loss.
Right, exactly. It's an automated order that basically says, hey, if the price drops below yesterday's low watermark, just sell my stuff immediately so I don't lose all my money.
Right. It makes total sense on an individual level.
It does. But the execution of that creates a huge structural vulnerability, because it's not just one person doing it. Millions of retail traders are looking at the exact same chart, making the exact same logical choice, and placing their safety nets in the exact same spot.
So it creates this massive concentrated pile of money.
Yes. And in finance speak, they call these piles of money buy-side and sell-side liquidity. But to put it simply without the jargon, it's just giant piles of resting orders.
Wait, so let me get this straight. If I'm a regular guy trading on my laptop in my living room, my little safety net is exactly what the big institutions are actively hunting for.
Unfortunately, yeah. You are exactly what they're looking for.
But why? Why do billion-dollar banks care about my tiny little trade?
Because of their size. It's actually their biggest problem. If you or I want to buy, say, 1,000 euros, we click a button and it's done.
Right, the market doesn't even notice.
Exactly. But if smart money wants to buy $1 billion worth of euros, they can't just click buy. If they do, their massive demand will instantly consume all the available sellers, and the price will violently shoot up while they are only halfway through buying.
Oh, wow. So they'd end up paying terribly high prices for their own order.
Right. They'd completely ruin their own trade just by trying to enter the market. So to buy a massive amount of something without driving the price up, they need an equally massive pile of people willing to sell to them at that exact same second.
Oh, I see. They need that massive pile of money, the liquidity.
You got it. And where is the most predictable cluster of guaranteed sellers? Sitting right below yesterday's low in the form of all those triggered stop losses.
Wow. Okay, so that leads us right into the trap. The stop hunt, as it's labeled on our chart here.
Yeah.
If the big players know the piles of money are sitting just outside yesterday's boundaries, how do they actually sweep in and grab them?
Well, they essentially push everyone off the cliff. It's a two-step process on the chart here. You have the liquidity sweep, which leads right into the manipulation phase.
Okay, so what does that look like in real time?
Smart money will intentionally inject just enough capital to push the price of the asset down, nudging it just barely past yesterday's lowest price.
Yeah.
Just enough to cross that psychological boundary.
And once it crosses that line, boom.
Boom. The second it breaks that floor, it triggers a chain reaction. All those automated safety nets fire off at the exact same time. Thousands and thousands of retail traders are suddenly forced to sell their positions.
Which creates a massive wave of sellers.
Exactly. And waiting at the bottom of that wave is the smart money algorithm, just quietly absorbing all of that panic selling to fill its massive buy order.
That is just wild.
What's really fascinating here is, well, it's just how counterintuitive the whole thing is. The big players push the market in the completely wrong direction just long enough to absorb everyone else's money. They literally manufacture a panic so they have the fuel to go in the actual direction they wanted all along.
It's a total fake out. It reminds me of a classic head fake in basketball. You know, you have the ball, you step really hard to the left, your eyes, your shoulders, everything screams that you're driving left.
Oh, yeah.
And the defender logically shifts all their weight to block you. But the millisecond they commit their weight, you steal that momentum and you drive hard to the right.
That is a brilliant way to picture it. The retail traders are the defender in that scenario. They see the price breaking yesterday's floor, they panic, their safety nets trigger, and all their financial weight shifts the wrong way.
Right. And then smart money just drives straight to the basket.
Exactly. But there is a catch.
Of course there is.
If the sweep is the head fake, how do you, as an everyday observer, know when the actual drive to the basket is happening? Because when the trap is sprung, it looks exactly like a real market crash.
Right. If I'm watching my screen and the price plummets through the floor, how do I know I've just witnessed a trap and not, an actual financial collapse? Like, what's the tell?
To figure that out, you have to decode the next phases on our chart. We're looking for what's called strong rejection and displacement, followed by a market structure shift.
Okay, so let's translate that. Strong rejection and displacement. What does that actually mean for the regular person looking at a chart?
Displacement is the aggressive, unmistakable move in the opposite direction right after the trap is sprung. Remember, the algorithm just bought up all the available supply to fill its huge order, so there's nothing left holding the price down anymore.
Oh, so the price just snaps back.
More than snaps back. It violently surges upwards. That aggressive surge is the displacement. It's the footprint of a massive institution suddenly hitting the gas pedal.
But a fast move up isn't really enough proof on its own, is it? I mean, markets bounce around all the time.
No, you're absolutely right, which is why you need the second part. The market structure shift, or MSS.
Okay, what's that?
Think of a downward trend like a staircase. The price drops down a step, bounces up a little bit, then drops to a lower step. It's a clear structural pattern. A market structure shift happens when that explosive displacement surge is so powerful that it violently breaks above the most recent step on the staircase.
Oh, I get it. It literally breaks the pattern.
Exactly. It's the definitive structural proof that the downward momentum was fake, the trap is over, and the real move upward has officially started.
And looking at this blueprint, it shows this happening on both sides, right? Like, the bearish setup starts with a fake out at the very top, sweeping the high mark. And then the bullish setup starts with a fake out at the bottom, sweeping the low.
Yeah, the mechanics are perfectly mirrored.
It's just the exact same psychological trap, just flipped upside down, depending on which way the big players want to go.
Precisely. Fear at the bottom and greed at the top. The algorithms don't care. They're just harvesting the predictable reactions.
Okay, so let's say we've seen the trap set. We saw it get sprung, and we saw the reversal pattern. We know it was a head fake. How does an everyday person actually use this game plan to their advantage?
Well, now you have to look for your entry point.
Right, because if the trap is sprung and the big players are now moving the market super fast in the real direction, how do you jump in without just getting completely run over?
You definitely do not want to just blindly jump in front of that momentum. To do it safely, you look for the footprints the big players left behind. On the chart, this is marked as the entry at the FVG, which stands for fair value gap, or the order block.
Okay, fair value gap. That sounds super technical. What is it, really?
It's actually pretty simple. When the smart money initiates that violent displacement surge, they are buying so fast that they leave behind a literal pocket of empty space in the market's pricing.
Like a vacuum.
Exactly like a vacuum. And what's interesting is because they move so fast, they often don't get 100% of their massive order filled on that first push. So the algorithm temporarily pauses.
And when it pauses, The price naturally dips back down into that vacuum.
Yes. The market briefly dips right back into that specific fair value gap to cleanly fill the rest of the big player's order, and then it finally takes off for good.
Oh, I love this. It's kind of like missing the initial boarding for a train because there was some confusing announcement at the station.
Right.
But this specific train always rolls back down the tracks just a few feet to switch lines before it actually leaves the station entirely.
That's it, perfectly.
So that little rollback, that's your entry zone. You don't chase the train down the tracks. You just stand there, wait for it to roll back, and casually step on board.
Yes. It requires a lot of patience, but that rollback into the fair value gap is your safe entry point. Most people panic and buy at the very top out of the fear of missing out, but you just wait for the train to roll back to you.
Okay, so you're on the train, you waited for the gap, you jumped in. What's the final destination? What's the target?
To figure out the target, you just have to think about what the algorithm wants next.
More liquidity. More of those safety nets.
Always more liquidity. So if the market just faked out the bottom, if it swept yesterday's low to grab fuel for a huge run upward, where is the next massive pile of money sitting?
Well, it'll be sitting right above yesterday's high, right at the other boundary.
Exactly. That becomes your ultimate target. It sweeps one side of the board just to fuel a massive run all the way to the extreme opposite side of the board.
Wow. Just swings back and forth.
Yep. It's constantly hunting the sellers at the bottom to fuel a run that eventually hunts the buyers at the top.
That's honestly incredible to think about. It completely changes how you look at a financial chart. Which actually brings us to the key takeaway printed right here on the chart, which I think summarizes this perfectly. It says, where liquidity is taken, the real move begins.
Yeah, that single sentence is everything. It's the ultimate rule of institutional market flow. If you're just constantly reacting to where the price is drifting, you will always be trapped. You have to look for where the massive piles of retail money are being absorbed, because that is the ignition switch for the real move.
Right. And, when you take a step back, this whole thing isn't really just a financial tool, is it? It's a map of human psychology.
Absolutely. It shows exactly how the crowd is lured into this false sense of security based on yesterday's boundaries. They get completely outmaneuvered by players who don't just see the lines, but who see the whole board.
Yeah. And that leaves us with a really provocative final thought for you to ponder today. We've just spent all this time dissecting how the biggest, most powerful players in the financial world build their strategies entirely around predicting where everyday people will place their safety nets, right?
Right. They bank on our predictable habits.
Exactly. So if you zoom out from the charts, where else in your daily life are your predictable habits and your comfortable safety nets being quietly used as liquidity for someone else's strategy?
That is a very unsettling question.
It really is.
Oh.
Well,